Welcome everybody to the Klaas Financial Social Security webinar. I'm Nate Bribey. I'm a financial advisor in our Rockford office here. We also have Alyssa here that I will let with Klaas Financial and let her introduce herself.
Hi, some of you know me. I'm Alyssa. I'm a financial planner here in our Loves Park office.
Very good. And then we got Megan Forristall from the Social Security Administration, our special guest. She's going to be running through the presentation today, but we're so lucky and blessed to have her do these presentations for our clients. And I think we're going to go over not only Social Security benefits, but also some Medicare stuff, I believe, too. Correct, Megan?
Yes.
So most of you, I'm looking at the list now, are our clients or have worked with us in the past at least and know a little bit about us, but we do post these on our website too. So I'll give a brief background on Klaas Financial and what we do, and then we'll turn it over to Megan here. But like I said, Alyssa and I are with Klaas Financial. We're a financial planning, retirement planning firm in Rockford. Also have an office in Madison, Wisconsin. We've been around for about 48 years now, and we serve about 1,000 different households over about 32 different states. So we're very proud of our reach and our clientele and being able to serve clients for a number of years. So part of the financial planning process that we mainly focus on is retirement planning, making sure people have enough money to retire. Today's presentation, we're mainly focused on Social Security. That's definitely a big focus we have for our 60-year-olds when they should claim their benefit, understanding Medicare at 65 and what options they have there. Megan and Alyssa and I were just talking before we hit record about if you have a state pension that may affect your Social Security benefits, things to be with those. Unfortunately, if you lose a spouse, there is what's called survivor benefits to be aware of, spousal benefits for non-working spouses. So all these fun stuffs that you may read about or hear from your friends or peers. We'll touch on it briefly today. But yeah, I think that gives us a good background, Megan, and we'll turn it over to you, and we'll be monitoring the chat, I guess, is the last thing. So if you do have a question, there's two spots to post it. I guess we'll say the Q&A box at the bottom of the Zoom screen would be the best to ask a question. If they're simple ones, Alyssa or I will answer those in the Q&A. If we think it's appealing and something we can't answer, we'll turn it over to Megan. And if we have time at the end, we'll also do a little bit of Q&A at the end too. So you could feel free to ask questions throughout the presentation or at the end as well. Go ahead, Megan. Thank you.
Hey, thanks so much, Nate. So as Nate mentioned, my name is Megan. I'm a public affairs specialist for Social Security. Been with the agency for over 19 years now, and I am actually based in Peru, Illinois, but I cover most of northern and north central Illinois, a lot of the suburbs north of Joliet. So I have quite a wide area with 17 offices, including the Rockford office within my area. And so today we're going to go through pretty much basics as far as retirement, spouses, survivors, and Medicare. But if you have any questions we don't cover, like Nate said at the end, you can ask me about pretty much anything Social Security related. And I might get time to show a couple things on the website too, if we get some questions where I can direct you to find more information there. But we're going to start today by talking about retirement benefits. Because of course, when people are thinking about Social Security, that's kind of the thing they think about most in regards to Social Security as our retirement program. So as far as how you qualify for a retirement benefit, when you're working and you're paying those FICA taxes that we see come off our paychecks, you're earning credits toward retirement. And you need 40 credits, which a lot of us are going to have within 10 years of work to get a retirement benefit. Now, just because you earned your 40 doesn't mean you get to stop paying your FICA taxes, though. Even if you draw retirement and keep working, we're always going to be paying those taxes unless you're from one of those jobs that has a non-covered pension. So just a note there, because I get a lot of questions from retirees about why they're still paying those taxes with their work. But we're going to keep paying those because we're contributing toward today's beneficiaries and also paying into the system to figure out what we're going to receive someday. So the reason I said a lot of us will have them within 10 years of work is because you can get up to 4 credits a year. So this year, you only need $6,920 in gross taxed earnings to get those 4 credits. So I remember back when we used to send out those paper statements every year. When I was 26, I had my 40 credits. So I had a retirement estimate in there because, I did tasseled corn and worked those summer jobs and worked into that. But also you can't get a retirement benefit until you're at least 62. So I was still pretty far off from drawing for retirement. I still am today, in fact. But the other thing is, of course, my monthly benefit was not very high if I looked at that estimate back when I was 26. And that's because when we are determining your Social Security benefit, and by we, I mean the computer, because I do not manually, don't have to worry about me sitting there with a calculator and getting this figured out for you. What we're going to do is we're going to take your wages and we're going to adjust them for inflation. And then we're going to find the monthly average of your 35 highest years of earnings. Now, that step 2 is something a lot of people are not aware of. You might think, oh, I can't stop working at 55 because Social Security looks at my most recent 5 or my most recent 10, but it's actually your 35 highest years of earnings. And from there, we get your average index monthly earnings and we apply a formula to that. Now, if you're interested in the nitty-gritty of the calculations, you can find that information on SSA.gov. If you're someone who's really into math, that's not me, but you can go on and do manual computations to figure this all out. But I'm going to show you toward the end where you can find it if you're like me and you just want the facts and you don't want to do the work behind it. I'm going to show you how to find your estimates toward the end.
Megan, a question on
Yes.
that. One thing we get with, say someone who quits their full-time job and works part-time, you just explained this, but this is a common question we get, say you're making $80,000-$100,000 throughout your late 50s, you reduce your hours and go part-time and only make 30 to 40. That's not going to hurt your benefit. Earnings can only help your benefit, not.
Right. If as long as you have 35 years and not zeros in there, anything you do is going to help it. So, I was just talking to a friend and he's worked for State Farm forever. We're both at around, he's going to be 20 years there this summer. So he might decide to retire when he gets, his 35 years in or whatever, but he won't be old enough to draw Social Security yet. And so I just said, that's okay. You can move on to something less stressful maybe, or, completely retire and you're going to have your 35 for Social Security. So, that's something that is a real misconception. I would say one of the biggest misconceptions we have is people not knowing about that 35 highest when I'm out here giving these presentations. So the next slide, we're talking about what is the best age to start receiving Social Security benefits. Now, at Social Security, we are not financial planners, so we're not going to tell you what to do, or even give you too much advice on that, other than the thing we can tell you, which is what your money amount is going to be every single month from 62, which is your earliest retirement age, on up until your full retirement age. Now, for this example, the person's full retirement age is 67, but we'll look at what yours is going to be in a moment. And between full retirement age and age 70, you're going to earn delayed retirement credits, which average about 8% per year. So purely from a financial point, you're thinking, well, between 62 and 70, that's over $1,000 a month more if I wait to take it until I am 70. And so some people will say, yep, I'm good to keep waiting and I'm going to wait till I'm 70 and max this out. But everyone is going to be different. So your answer might be different than your neighbors or your spouses or your best friends. And so that's something to consider, because one thing some people look at is longevity. So, if they say, well, everyone in my family lives to be 100, then they probably are going to try to possibly wait and max out their Social Security. But if other people say, that's not really what my family history suggests, and I want my money and enjoy it now, that might be part of the decision, whether they're still working, whether they're wanting to stop work, but have other savings to live off of first. Those are all different considerations that people look at when making the decision as to when to file.
Megan, we had a
And,
question about
yeah.
gaps in employment if you're laid off or took a few years off when you had your first child or something like that. Can you just kind of talk through how that would work?
Sure.
There could be zeros, right, in the record.
Right, yeah. So if you do not have 35 years total, that's just going to be a zero in the computation. And we always look at your highest 35. So if you continue to work, even a small job after you start drawing benefits, we're going to keep recalculating that. So it could bump your figure up because you're replacing a 0 year. Even if you're just making $5,000 a year, that might, increase your benefit because it's replacing a $0 year. We're always going to look at those, but if there isn't, a lot of people will have zeros in their computation, and that's okay. It's just going to be part of that computation. And then just, letting you know that if you have 35 years of earnings, we're looking at the high 35. If you have 42 years of earnings, we're looking at the high 35. And if those include zeros, that's okay too. That's just how the computation runs.
Yep. Perfect. Thank you.
So here's where you can find your full retirement age. So everyone that's born 1960 or later, we're at age 67. So like if I take it early at 62, I'm going to have a 30% reduction. Of course, I am going to have, 5 more years of benefit checks than if I waited till 67 or even more until I waited till 70. So that's a lot of consideration there, how much money I'm going to collect in lieu of while waiting. So for me, part of the decision, of course, will be, if I'm still working and things like that. So we're kind of in the in-between time right now. I'm not going to lie. I'm not going to be too sad when I don't have to figure out this in-between chart anymore and everyone's full retirement age is 67 from that perspective. But you can find yours here. We have a lot of people coming to see us that are like 66 and 8 months, 66 and 10 months now. And we're kind of going toward the tail end of this chart, but I've been working with this thing for a long time. And this, we always say, people will ask us, are they raising the full retirement age? I am never going to be the person to ask that question because anything legislative, the cost of living increase, I find out the same day in the morning in the news before I get to my inbox at work. And so you can see it on Good Morning America just as fast as I can see it by getting to work and then going there. So those are all legislative issues. All we can talk about is what we work with, which is what we actually have in policy. So one of the things that is a consideration when you're thinking about retiring early is, are you still working? Because when you're under your full retirement age, we do have some work limits. And if you are over those work limits, we're going to hold checks in work suspense. So the way this would work is, let's say that you contacted us this month, we're still in March, and you're 62 now, and you said, well, I think I'm ready to go ahead and draw my benefits. But you tell us you're still working and you're making exactly $20,000 over this earnings limit just to make it easy. So you're still working. You might not be working as much as you used to, but you're going to keep working throughout the year, and you're going to be making a little over $42,000 this year. So what we're going to do is we're going to hold $1 for every 2 that you're over that in work suspense. So we're going to look at $10,000 of that you're over the earnings limit because we're only looking at half. And what we're going to do then is we're going to hold that amount of money in suspense because of your work. So let's say you selected March and your monthly benefit, to make it easy, is $2,000 a month. That means we have to hold 5 benefit checks in work suspense. So $10,000 in work suspense. We're going to hold March, April, May, June, and July. So even though you filed in March, you're not going to receive a check any of those months. You're first going to get a check for August, and all Social Security checks run a month behind. So you're going to receive your first check in September. So you might say at that point, well, I don't know if that's really worth it to me. You're going to start at the March 2024 rate, reduced rate, but you're not going to receive anything, actually see it in your bank account until September. Other people, they might say, yeah, I'm going to go ahead and start that. Let's say you went with that decision, you went ahead and started it, and we hold those 5 checks. The benefit of telling us about your work up front is when we hold checks in work suspense, we recalculate your benefits at your full retirement age, basically looking like you took it 5 months later than you did. We get rid of 5 of those reduction factors and we give you a higher rate. So that's why you always want to be as upfront as possible if you are working and you're under your full retirement age with your work plans. And I know that's a lot. Yeah.
Megan, I say, otherwise, if that's not, like, how is that caught when you file a tax return, right?
Yes. So if it's the second situation, and sometimes it happens where, you made a little more than you planned or whatever it might be, and that's okay. But if it gets caught later, you're going to have an overpayment, we're going to have to collect that overpayment from you, and you will not get the benefit at full retirement age of us having held those checks in work suspense. So that's why I always tell people, just a heads up as best you can. Of course, things vary. You end up getting overtime or whatever happens, you know, that might change. And then you're going to have a change with that. So speaking of calculators, got mine out of reach here. So this year, that's the 22,320. Anytime we have a cost of living increase, this is going to go up generally. So if we have a cost of living increase for next year and you're not retiring until next year, check back in on SSA.gov because the new rate will be there. The other thing is this assumes that you're working and making money all year. So that is one test we can use, but let's say a different scenario. You're working right now and you're like, you know what, this weather is all over the place. I might as well just be at work until it gets nice out here in Illinois or Wisconsin or wherever you might be. So I'm going to keep working, but I think I'm going to be done working in May. And you've worked and made, you know, let's say you made $80,000 between January and May. So you're like, oh, you know what, though, I can't get my Social Security because Megan told me the limit's 22,320 when I was listening to her. There's actually a different test we can use if you're going to stop work or significantly reduce work in that year you file. So the other test is just taking the yearly limit divided by 12, which is $1,860. So in that second scenario, even though you made $80,000, you can start your checks with June because you're done working and you're going to be under $1,860 as long as you stay under that monthly limit every single month for the rest of the year. So that allows you to go ahead and start filing mid-year, even if you've gone over that limit.
So it's not prorated for the remaining months. It would be divided by 12, right?
So it's just divided by 12 of the whole year. So you have to be under that 1860. But a lot of times people are more using this when they're pretty much completely retired.
Sure.
Or, you know, the 1860 allows you to get a little bit out of the house. Sometimes it's necessary in that adjustment period, but you do have to be very firmly under the 1860 for every month for the rest of the year when you're using that test.
Right, but you can make as much as you want through June. You can make 200,000, but just claim in July and say, well, I'm done in that earnings limit. The 1860 just apply July going forward for the remaining.
Correct. Yeah.
Very good.
Yep. And then the year you turn your full retirement age, you can see it's a lot higher of an earnings limit. That earnings limit would be for January up until the month before your full retirement age. And if you should go over, we only hold $1 for every 3. Then the first day of the month in which you hit your full retirement age, you can work and make as much as you want and still receive all your Social Security checks. So that's full retirement age. That's where we consider you to be getting your unreduced benefit, and you do not have a work restriction at that time. So before I dive into benefits for other people, since we just talked about that work slide. Those work limits are the same for the retiree and also the other categories of people we're going to talk about today. So even children have that 22,320 earnings limit. And children, spouses, surviving spouses, all the same with that earnings limit. But whenever we do have someone file for a retirement benefit or a disability benefit, survivor's benefit, we're always asking about anyone else who might be entitled to a benefit on the record. So for children, we're going to ask, do you have any children that are under 18, still in high school up until 19? So we can't pay through college, but we can pay up until graduation, or if they're still in high school at 19, it's going to cap at 19. Or 18 or older and having a disability that started before age 22. And all these categories, the person has to be unmarried. So for that last category, it does not matter if your adult child is now 30, 40 years old when you go to file for a retirement benefit. If they've had a disabling condition since before age 22, they're not married, and they haven't worked, substantially to get their own disability benefit, then be sure to list them on the application so we can screen them for disabled adult child benefits. It'll involve a medical decision, but as long as their documentation in file before age 22, they can potentially get that benefit off your record. Now, I'm just going to say we had a law change a while back. called deemed filing. And this applies to everyone born January 1st of 1954 or later. So I finally got rid of the deemed filing slide, but then I still get questions about it. But basically, this is how it works now because we're in 2024. So everyone's 70 now that would have the deemed filing provisions. So just assume if you haven't drawn yet, you're going to be having deemed filing. So what that means is before we look at any benefits for a spouse, the person needs to draw off their own record first if they have 40 credits. So this first category is somebody you are currently married to. The first thing we're going to do if each person has, and I should also say you cannot draw off a current spouse until they're either filing or already receiving a benefit themselves. So the first category, both people are on, let's say, we're going to look at 100% of an own person's own benefit. So that full retirement age rate benefit, no matter how old they are filing at, we're looking at their primary insurance amount, that 100%. We're going to look at 50% of their spouse's primary amount, no matter how old the spouse is when they're taking it. If 100% of a person's own is more than 50% of their spouses, there is no spousal benefit payable. Each person is just going to draw their own Social Security check. If it's less, we're going to still pay the person what we can off their own, but then the difference between the person's own and 50% of the spouse's off that spouse's record. But then if the actual person applying is below their full retirement age, we're going to apply the age-related reduction to both of those benefits. So it will not be the full 50%. Anytime we pay a benefit off a worker's record, whether it's a child's, a spouse's, a divorced spouse's, it never reduces the payment of the worker themselves. For spousal benefits, you generally need to be age 62, just like a retiree, unless caring for a child who is under 16 of the worker or who has a disability. So again, this first category, we're looking at current spouses. This next category is divorced spouses.
Megan, sorry, one more thing on spouse, just to reiterate, if you have a husband and wife, and the husband is the primary earner and he claims at 62, the wife can still wait to her FRA to get the full 50% spousal benefit,
Yes,
even though the primary earner claimed early.
Yeah.
That would only hurt the wife, the spouse in that example, if the husband predeceases her as a survivor benefit potentially.
Correct.
Okay.
So yeah, any type of spousal situation, you don't have to take your benefit just because your spouse is drawing, but if you want to get a spousal benefit, you have to take your own first. But it doesn't mean you have to draw by any means. That's your decision. It's just you can't access anything additional until you're ready to draw your own.
And just one more thing on that. That's what deemed filing means. If you have your own record, but you would get a spousal benefit and your spouse is drawing, you can't just say, I want my record and I want to defer my spousal benefit. Correct? That's what deemed filing means. You're deemed to file for every benefit.
Any benefit you're entitled to, yes.
Yeah. Very good.
Yeah. And so divorced spouses, same premise though. You're going to look at for your own record first before looking for benefits off a former spouse. A marriage has to have lasted at least 10 years to that former spouse, and you have to be currently unmarried yourself. So you can draw off an ex-spouse as long as you're unmarried and you meet this other criteria, even if they remarried. Somebody can have 3 or 4 different spouses on their record. I've seen it. So 3 former spouses and a current spouse. That happens sometimes. So there's no cap on that, but all these other rules apply. You have to be unmarried yourself. Marriage will last at least 10 years and age 62 or older, and we look at your own record first. Here's the big difference with divorced spouse benefits. The former spouse that you are looking to collect off does not have to be receiving, like in the situation of a current marriage. They just have to be eligible to receive their benefit, meaning they have at least their 40 credits, and they're at least 62 years of age or older. So if your former spouse is waiting till 70 to draw their benefits and you're eligible for divorced spouse benefits at 62 and they're way away from turning 70, we can still check their record for those divorce spouse benefits as long as they're over 62 and they have those credits. And anytime we pay a benefit for a divorced spouse, it does not reduce the payment of the others on the record either. So survivors benefits, the rules for children are the same as far as eligibility, but the rules for surviving spouses and for surviving divorced spouses have some differences off somebody who has passed away's record versus off someone who's living. So for surviving spouses, surviving divorced spouses, you can draw those benefits as early as age 60 or as early as age 50 if you have a disability. And again, any age of caring for a child of the worker who is under 16 or has a disability. The other thing about survivors benefits is you can remarry after age 60 and it will not affect the benefits. So that's another big thing that people aren't aware of sometimes. If you do find someone else, as long as you're over 60, you still keep that eligibility to survivors benefits if you get remarried.
And then you would have two records at that point, potentially, if you're
Potentially, but here's the other thing that we're going to talk about. We're always going to pay off the highest record that'd be eligible to you. So we're not going to pay you off both the current and the former spouse. We're going to pick one. But it's always not always the case, but it's more likely the case you're going to be on the survivor's record. And that's because you can get a higher percentage off a survivor's benefit than you could off your current spouse. So now the other thing though is if you're still staying on the survivors and your second marriage, that person unfortunately passes away, if they were the higher earner than the current survivor's benefit you're on, then at that time you could move to that person's survivors too. So there's always an eligibility change, that if you're entitled to a benefit and you meet the eligibility requirements and the higher one comes along, we can do that application as long as you meet the eligibility requirements.
So if you're on survivor benefits and your new spouse filed their benefit and you were entitled to spousal benefits on there, if it was higher, would you switch to spousal benefits on the new?
Right.
Correct.
Right. But then if they should pass away and then it's going to be higher because it's a survivors than your current survivors, you could then go on to that survivor's benefit instead. Not getting both again, just getting that higher one.
Yep. Perfect.
So again, that 50 is only if you have a disability. You have to have a disability decision to get survivor's benefits at 50. But 60 is the early age for survivor's benefits. At that time, it'd be about 71.5% of the worker's benefit. It goes up every month. You wait until full retirement age to get up to 100% of that survivor's benefit. Now, these do not have delayed retirement credits, so you do not want to wait past your full retirement age to draw a survivor's benefit. So again, just a little breakdown because this gets confusing. The benefits of someone who's living versus someone who's passed away for a current or divorced spouse. Spouse's benefits start at 62 and you're getting 50% or less. Survivor's benefits as early as 60 or 50 if disabled, 71.5 to 100%. So if you were not eligible for survivors or spouse's benefits and your spouse or you find out a former spouse has passed away, contact Social Security because we used to get like a form from the funeral home and then we would call, potential survivors. Now pretty much everything is done electronic, which is great for a lot of things. The only downside is we don't get the notification of potential survivors. So we need people to contact us to file those applications. So if you're not sure, I didn't qualify for spouse's benefits and now I'm not sure, but your spouse just passed away and they were getting more money than you, then you definitely want to contact us to get an appointment set up for those survivors benefits. So the other thing, just to add, like the confusion that we like to at Social Security and trying to remember everything, is that I really drilled in that deemed filing to you before. That does not apply to survivors benefits. So if you have not filed yet and you have the option between your retirement and your survivors, you want to do some strategizing before you make your decision, because you could take your survivors as early as 60 and keep letting your own retirement grow. You can grow as early, take it as early as 62 if it's higher then, but you don't have to take it just because it got higher. You can let your own grow all the way till 70, which is somewhat common with survivors benefits. The other strategy you could do is take your retirement at 62 and let the survivors grow to the maximum amount at full retirement age. So you do have some options there to look into when making decisions involving survivors' benefits that you do not have when all parties are still living.
Megan, I think you'll get to this, but we just had a question about spousal Social Security benefits impacted by pensions and non-covered pension and weapon GPO.
Yeah,
So
and I don't know if I have those slides in here, so I'm going to pull up the information at the end
okay,
because and I do have slides probably in my email, so I can pull them up too because I just did that. So we'll get through this, and then if we have time, I'm going to grow more into the non-covered pension for sure. Because it is a little bit different story with that. So we'll get through all our basics and then we'll come back to that for sure.
thank you.
So the lump sum death payment is a one-time payment that we have. You probably have seen this made fun of on life insurance commercials that come on Sunday morning TV. I know I have, but it is only $255. I'm sure it's been $255 always. I can tell you it definitely has for 19 years. So that is only payable to a surviving spouse or a child entitled on the record. It's not payable to the estate or a divorced spouse, something like that. And a really uncommon type of benefits we have is parents' benefits. And this would be if the adult child was providing half financial support to a parent age 62 years of age or older and the adult child passed away. Not very common at all, but that is something we have available. Okay, so that kind of covers the money benefits we're going to talk about. And we're going to switch gears a little bit to Medicare. Now, I just want to preface this by saying at Social Security, the only thing we do with Medicare is enrollment in Part A and Part B. All the other stuff we leave to other parties. So Part A is your hospital insurance. If you have 40 credits from your own earnings record, a spouse or a former spouse, you do not pay anything monthly for Medicare Part B or Part A. Part B is your medical insurance. This is Part A is hospitalization overnight or longer. Part B is outpatient visits, outpatient procedures, certain medical supplies. A lot of stuff falls under that umbrella. And that is a base premium of $174.70 a month this year. Some people pay more. Now you can add Part D onto it. That's actually when I got hired, is when they started Medicare Part D. And that is in drugs. That's a private company though, private plan. So Social Security does not do the enrollment for that. And you can add supplemental or called Medigap. That's anything above the letter D for a plan is in those supplement categories. So that's original Medicare. And then increasingly popular is Medicare Advantage plans. You're still going to enroll in the A and the B through Social Security. But then if you're wanting to get the Medicare Advantage plan, again, you're going to go through the private plan, or there's some counselors that are trained by the state you can use to help you pick plans as well. But they're going to help you wade through all that. Some people like the Medicare Advantage plans because they usually have the Part D plan right alongside it figured out for you. And they might have things like vision, hearing, dental that are not that well covered by traditional Medicare. Some have lower out-of-pocket costs as well. So as far as when you can get onto Medicare, the big time people are thinking about is age 65. That's the earliest you can get it based on age alone. But we also have Medicare after 24 months of Social Security disability. So if you're found disabled on Social Security, that's going to be automatic after 24 months. We have a special provision for kidney failure where you can actually still be working and get that type of insurance. It's called end-stage renal disease if you're receiving dialysis or receiving a transplant. Then the ALS, that's separate because you still do get a disability decision for that Medicare, but with ALS, they no longer have the 24-month waiting period. The Medicare starts right away. So as far as age 65, though, the first opportunity to get into Medicare is your initial enrollment period, the 3 months before your birthday, the month of, and the 3 months after. If you want it to start the first day of the month in which you're 65, you need to get it done in the 3 months before. If you're receiving a Social Security check prior to turning 65, you will automatically be enrolled with the first day of the month in which you're 65. You'll get a card in the mail for the Medicare A and B. A lot of people accidentally throw it away. So just be on the lookout. I know you're getting a ton of junk mail around that time, but just make sure you're opening it all carefully because that card comes about 3 to 4 months before your birthday. So if you're needing it at 65 and you're not on benefits, make sure you file that application. As long as you do it in the 3 months before, it's the first day of the month. If you wait till your birthday or the 3 months after, it's going to start the following month. And then there are as a category of people that don't need to worry about Medicare, especially the Part B, if you're still working and covered under group health insurance. So most people, I mean, there's certain exceptions where an employer will ask you, oops, sorry, to go through and get into Medicare. But most people who are working for a larger group health plan, you know, a large enough employer with a group health plan will be able to wait on Medicare and not have to worry about penalties. Because let's say, you know, with my job, or if you're working at Walmart or working in any of those places, almost all, and when you turn 65 and you're still working, you're covered in our group health plan. You don't want to pay for Medicare also because for that Part B, because it's going to be a secondary. So the only time it would come into play is if your insurance flat out refuses to pay for something that Medicare somehow covers, which isn't going to be common. So in the situations, if you're still working or your spouse is still working and they're covering you on current work, we always say, check with the benefit specialist, confirm they don't want you to do anything through the HR department at work, and otherwise you'll qualify for that special enrollment period. That's anytime after your initial enrollment period when that work is going to be ending. You can get into the Medicare. You will not have any penalties for the Part B because the employer is going to verify that you've been employed or your spouse has been employed and they've been covering you since age 65. So that you can get into anytime then within 8 months of when the employment ends. And then the last period, that's if you just kind of missed your initial enrollment period, didn't realize it, or thought you would never need health care because you're always very healthy and then started getting health problems, whatever it might be, that's when you would have to wait for the general enrollment period. So some situations where I see this more often would be if someone was under a retiree insurance and they misunderstood that they needed to get into the Medicare because it wasn't active employment. Some people are on the VA health system and they think they're only going to use the VA health system and then they change their mind later and want Medicare. Or if you're on a self-employment or if you're on the marketplace and you thought you could keep the marketplace wants you in Medicare when you're 65. So those are just situations to be aware of and make sure you're doing your planning properly. But the general enrollment period is available for people who missed that initial enrollment period and they don't have that special enrollment period. It's January through March of every year. The coverage begins the month after you file, and there is a 10% penalty onto your monthly premium for every year you did not take the coverage. So that's why you got to be really good at just double checking everything coming up on 65. There is a lot of information on ssa.gov about Medicare enrollment, the basics on the parts of Medicare, and you can sign up for Medicare. You can do your Part A and B application. You can select Part A and refuse the Part B. And you can just do the special enrollment period if you're already on the Part A by either mailing or faxing or submitting online or dropping off at the office the 2 forms for the special enrollment period, which are the 40B and the L564. That L564 is the one the employer completes. Now, I just want to highlight the special enrollment period a little bit more because it's kind of confusing as to when your coverage might start with that. If you sign up for your special enrollment period, you bring us those 2 forms while you are still working or in the first full month after you stop working. You get to choose. Do I want the Medicare right away or do I want it any of the following 3 months? However, if you wait till the next 7 months, it's going to be the first day after the month after you sign up. So we can't take it retroactive. So just kind of work on that planning too, and your corresponding with benefits between your employer health and your Part B. Otherwise, for all things Medicare, for information about the different plans, for information on what Medicare covers, you can go to medicare.gov. You can create a personalized account with them and get all the details on those sorts of billing questions and things like that. And I mentioned the base premium this year is $174.70 a month. Not everyone is only paying the 174.70. There are people who do pay more. This is called IRMA for income related monthly adjustment. This is based on 2 years prior modified adjust gross income from your taxes. So we're looking at 2022's this year. I just want to mention in this part, I'm not going to read through the whole chart. You're going to have that information. It's also going to come in your letter if this applies to you. The thing I want to highlight here is if you get a letter that says this applies to you, please open it, please read it carefully, because some people can have this adjusted, but we cannot adjust it for a past time period. We can only adjust it for the time the person submits the form requesting this adjustment. So your letter will talk about, this is why you're paying more. It might be accurate and you might have to keep paying more. Or you might have something called a life-changing event. There'll be a whole list of them, but the one I want to highlight today is work stoppage, because it's retirement age. So if you stopped work or greatly reduced work, and it's going to drastically change your modified just gross income to bump you into a different tax bracket on this chart, or even completely take you out of needing to pay an additional amount, there'll be a form number, an SSA 44. It's talked about in the letter. Get that and the proof of your life-changing event. It'll have that in a chart for you to your Social Security office as soon as possible. We'll stamp it when we get it in. We might not get it worked exactly that day, but if you drop it off March 31st, we got it in March, versus if you drop it off next week when we got it in April, or mail it in those dates. So just to be aware of, because I had a lot of people kind of put it to a side, and then they still had to pay that additional amount for a few months because they didn't get their paperwork in. So read that carefully. Now, other people, they might have it all the time, this additional amount, just due to their income. And then some people might have it for 1 year because maybe they sold a home and they're going to have it higher for a year. It'll go back down the next year. As far as how to apply for all the benefits we talked about today, retirement, spouses, we didn't talk about disability, but that's available up until your full retirement age. And Medicare, all available on ssa.gov. That's the easiest way to file. Otherwise, if you're filing for survivors, not available online, call and schedule an appointment, or if you cannot use online services, call our toll-free number. They'll set you up with a phone appointment. We do in-office appointments, but generally that's just for people who have some barrier to phone service. The reason we like to keep them over the phone is that we can move our work around that way. So maybe Peru office is going to take Rockford's appointment someday or something because they have too many things else they need to work on. So phone appointments allows the area to help each other and keep our appointment calendars in the best shape as possible. But if you need an in-office appointment, just call and specify for that you're in need of that in-office face-to-face. This is the ssa.gov website. This is what you should see if you are putting in ssa.gov. So not a .com. Do not put it in the search box. We're trying to spend the money to be your top hit, but if someone outbids us, they're going to be first on the Google search bar, and we can't use all your taxpayer dollars to be the first Google search. So we're doing our best, and we're doing pretty good at it, but make sure it's the .gov that you land on, because I get a lot of people who are putting it in the search bar instead of at the top, and then it's a long conversation to getting them to the correct spot sometimes. Everyone over the age of 18, we encourage to have a My Social Security account. So if you do not have that yet and you're working with your financial planner, I bet they're going to ask you to have one too, because they like you to bring that statement of your earnings into your appointment most times, I think. So ssa.gov, again, that's where you're going to go create your online account. I've had one for years. So what I have is a username and password. But if you set one up after September of 2018, you might have a different way of logging in, either through login.gov or id.me. If you've never had an account, you're going to be asked to create one. You're going to be asked to hit create an account like 3 different times. So it's going to take you through from our site to login.gov. You're going to finish doing their account with them. They're going to take you back to our website to get an activation code and finish setting that account up. If you have trouble doing this, you can bring a valid form of identification into your local office to get that activation code. Kind of helps you along some of the security stuff. And the reason we want everyone to have these after age 18 is there are a lot of great features. So let's say you have someone younger in your life and they cannot find their social security card. They have to start a job. They're getting ready to graduate college. They're like, you have this card. Nope, that was your responsibility. They lost it. Anyone with a driver's license or state ID can generally replace their social security card right online. Do not have to take off work to go into the social security office. Do not have to wait in line. So that will just come in the mail. I just tried it out the other day because I hadn't done it yet. Got the card just fine. You can check the benefit, you can get all your benefit estimates. Like I said, we used to have those paper statements. If you really like those PDF version, or you need to take it to someone to review, you can print that right up from your online account. It'll have, your estimate of earnings, but it also has even more details within the actual account that are not on that PDF document. So you can get all your estimates for retirement, disability, for your survivors should something happen to you. And once on benefits, even more you can do, including checking, your benefit information, printing proof of income. A lot of people ask for that for different agencies, things like that. You can print it, change your address, phone number, direct deposit, get a new Medicare card if you replaced it or missed it. And replacement 1099s, we're here in tax season. You can actually get up to 6 years past now. They added that enhancement into the online account. So if you need a previous tax year, you can get that there too. And then here's that social security statement. That's what you would be printing up. If you get it, if you do not create an account ever, you will start getting them in the mail again at 60 once a year. But if you're missing earnings, that's not a great time to find it out. So I just talked to a person not too long ago at an event. They were missing 1992 and 1994. And I said, well, back then we were actually sending you those paper statements every year. Because I didn't look at them. And that's one of the reasons why we want you to look. Because now if that person wants those earnings credited, he's got to find the proof of them from 1992 and 1994. That is much easier to do if you're looking at it today and saying, 2022 is missing. I'm going to get that W-2 into the local office. So that's one reason we want to look through these carefully, but you can still get those statements. And this month we had our Slam the Scam Day. It's just a good reminder, not just phone scams now, there's email scams, text scams, Facebook scams, all sort of stuff. If it seems suspicious, don't click on it or hang up the phone. Never give personal information. Even if it's really Social Security, you can hang up. We won't be offended. Just say, you know what, I'm going to call the office. And you can call the office and say, do you really need something from me? And we'll check it for you. So just be aware of that. We're on social media. And just a reminder, this is up to date as of today in 2024, but always we're going to have the latest on ssa.gov.
Perfect. Good work, Megan. Good work on time too.
Yeah.
Well, yeah, we'll go till 5, everyone. So we'll have these last 10 minutes here to answer questions. I guess, Megan, if we want to go to the spousal benefits and non-covered pensions,
Yep, I'm going to pull up our website for that.
Yeah, thank you. That's a great question. I was just telling Megan beforehand, we had a few clients ask that one, so. And once again, everybody down at the bottom, Q&A would be the best spot to type your question. Also, I suppose if there's a raise hand feature at the bottom as well, as you may have noticed, everyone is muted during this call, but if you want to raise your hand, we can also do a live question if you have a more complicated one that you just want to have a brief discussion on, or prefer to ask that way. So that would be the ask hand feature at the bottom.
Okay, so I'm just going to show you the publication we have in it too. Now, government pension offset is pretty straightforward. The other provision we have is a little more complicated, involving non-covered pensions, but government pension offset is when you do not, or you're not going to get necessarily off your own record, or maybe you're seeing if you can get additional off a spouse record or survivor's benefit. So let's say you always paid into a non-covered pension. You do not have your 40 credits, but your spouse is receiving, or maybe your spouse has passed away and you're wanting to receive off of their Social Security record. This affects people who are receiving a benefit based on their own earnings into a non-covered pension. we are going to look at 2/3 of that non-covered pension. And you can be completely reduced, meaning you're going to be down to zero on what you can receive. So if you go to ssa.gov, you can go to our publications and type in government pension offset. I can put this, is the chat working?
Yes, it should be up.
I'll stick the link in the chat too, so you can go right to this publication. See if I can get this to everyone. Oh, maybe I need to put it in the queue. Is it going to go to everyone? I'm not sure it is.
I can.
Yeah, I'll put it here and then you can move it if you need to. Because I
Yeah.
think they're not able to see it there. But a lot of times, if you worked your entire career into like teachers' retirement system or some form of non-covered pension, you're not going to be eligible for anything, even survivors benefits off Social Security, just because, to be honest with you, how high your pension is going to be, even at 2/3, compared to what we can pay off a Social Security benefit. Now, if the spouse that passed away, it's a survivor's benefit, and they had a very healthy earnings record, you might be due some off the government pension offset, but we're going to reduce it by 2/3. So let's say that the survivor's benefit is $2,000, 2/3 of your pension is $2,400. That's too much. You're not going to be due anything. But if 2/3 of your pension is $1,800, you're going to get $200 a month from a survivor's benefit. And the thing about this too is if you are eligible for anything, you need to report your pension increase every single year to Social Security to make sure we don't overpay you, because we're gonna have to recalculate that 2/3 every time you have an increase. So again, that publication walks you through it. This is completely different than if you have 40 credits and you have a non-covered pension. That's a completely different rule. I might get you the publication for that too, just because a lot of times, especially with teachers, you'll see maybe they worked at a private school, or maybe they have to supplement their income like so many teachers do with side jobs during the summer or after school. Then you'll have your 40 credits, but you will also have that non-covered pension. And so that is where you get into windfall elimination provision. So I'm going to put that one in here too.
How do you know if your pension is non-covered? I mean, I know it's TRS, SIRS, IMRF is covered, correct?
Yes, the easiest way to do it is to look and see if you're paying those Social Security taxes.
Yep.
So I remember I have a friend who works for the University of Illinois at one of the museums, and he got his paper statement after he had been he worked in college there, and it was like the first or second year out of college. And he's like, why don't I have anything here? And he had his Medicare earnings, because a lot of times they pay Medicare taxes. So I'm like, because you're not paying into Social Security, so you're not going to get any Social Security. But it was a shock to him at the time. But usually by the time people get to retirement age, they kind of are aware of what's happening. But the windfall elimination version, that's the one that has a lot more to it. So it's good to get your My Social Security account and get the publication. If you have your 40 credits, take a look at your earnings record and compare it with the substantial earnings years, because the more years of substantial earnings you have into Social Security, the less effect of a windfall elimination provision you have. So I deal with a lot of judges from Illinois too. They were working as attorneys most times for many years prior to becoming a judge. So sometimes they'll have little or no effect of the non-covered pension because of all those years spent as an attorney before becoming a judge.
Also, Megan may have already said this, but there's a good calculator through Social Security as well that we've done personally for clients through Klaas Financial, getting the earnings record and that non-covered pension amount. That calculator gets pretty darn close too. So
yeah, let's see if I have a link to it here.
that's the biggest thing. You just need your earnings record and the non-covered pension amount. Correct, Megan? And don't worry about the math of it. Just know those are the two inputs that you need, and the calculator will tell you what the reduction would be.
Yeah, so here's all our calculators. So if you have that non-covered pension, the retirement estimator will not work behind the My Social Security firewall. But for everyone else, like when Nate was talking about, well, what if someone stops working when you're 55? go in and use this retirement estimator because it will adjust your estimate for you. Or if you're going to start getting a part-time job, or if you're getting a better job and you're going to start making more, that's where you can play around with those. And then we also have those other calculators here, and down toward the bottom, you can find, the My Social Security or the windfall elimination calculators and stuff too. So.
Perfect. Megan, two more quick questions. Are the slides available for publication? Can we send those out to clients?
Yeah, did I send you the handout version of them, I think?
We'll check, but yeah,
but I'll make sure, you can have the PDF version to send out always. That's no problem.
Thank you. We'll do that. And then this, I know the answer depends, but if you can just touch on this again. The question is, is my spouse still eligible to receive Social Security in addition to their teacher's pension? So let's just assume it's TRS.
Yeah, so again, it's going to depend. If they have 40 credits on their own from other jobs, they're always going to be due something off their own record. That is not the case for government pension offset as a spouse on your record or a survivor off your record. It can be completely offset. It's dependent on how much that non-covered pension is.
Perfect. I thought I saw a hand go up. Did someone have a question they wanted to do live? If you can, just put your hand again or type in the chat. That would be great. Oh, there we go. John. All right, John, I should be able to unmute you and allow you to talk. All right, John, go ahead. I think we can hear you.
Hi, I was just trying to get into the chat, but this is faster. What do I have to do as far as registration if I work past 65 in order not to pay the Social Security or the Medicare penalty?
Sure. So you don't have to do anything now, except for confirming with your employer that they don't want you to take Medicare for any reason. It's when the employment stops that you're going to need them to fill out the form at that time, verifying that you've been actively working and covered under their insurance every single month since turning 65.
Okay, so I turned 65 and I accidentally signed up for Medicare Part A thinking I had to. I'm put in the form to reverse that.
Well, do you have an HSA?
Yes, and that's when I found out when I was no longer eligible for the HSA.
Okay, yeah. I was gonna say that's the only time you would need to worry about it. So how long ago did you put into file?
I filed last November.
Okay.
And then I put in the new form the day before yesterday to get Part A closed. I just wondered, am I going to have to pay a penalty? Apparently not. There's no more action until I stop working.
Nope, no penalty. They just have to get that. It's a withdrawal at that time. So they have to withdraw your entire claim. Okay. So in case anyone else is thinking about this, the only time you have to be concerned about having Part A is when you have the HSA, the health savings account. Not from us, but there's implications with the HSA of having Medicare. But otherwise, if you have Part A and you do not have an HSA, you do not need to get out of the Part A. The Part B is the only one that costs money, so you can just refuse the Part B if you're still working, keep the Part A. Only in situations like John's do you need to worry about having that Medicare Part A. And I especially want to mention this because it is automatic when you're receiving a Social Security benefit. You cannot be without Part A if you're 65 or older. And actually, if you're past 65, your Medicare is going to backdate. Part A is going to go back up to 6 months or to age 65. So it's really only worth pursuing getting out of it if you're going to be not on Medicare for more than 6 months past your 65th birthday.
Perfect. All right, great question, John. I'm going to turn yours off, and then it looks like we're going to go to Jane has a question too. All right, Jane, you should be able to talk.
There we go. Now you're on. Okay. So my question has to do with the capabilities of the Social Security website to do maybe what I consider difficult calculations. So I myself am, currently taking a pension, let's say a teacher's pension. I worked for the system 23 years in Illinois. Plus, I do have over 40 quarters of Social Security. So before I entered the teacher system, I worked in regular jobs with Social Security.
Mhm.
So if I do my calculations, do it all on SSA.gov, will it be able to do all the calculations, or is this something I need to do in person with someone?
No, it does a good job of doing the calculations if you go through the windfall elimination calculator. So you just have to make sure you're using
Right,
the right one.
because then it looks like, I mean, from what I'm hearing, it sounds like my spouse would be eligible for my benefits also, or part of my benefits, although he gets a pension too. So it's kind of like, so just as long as, I'm clear that I could still, when I do claim Social Security benefits, I can do everything online and it'll come up with the calculations.
Yeah. So to be
Okay.
clear, your My Social Security account will not have the correct calculation. You have to use this web calculator to get the correct benefit estimate. Because the My Social Security estimate that all the rest of us receive does not consider your non-covered pension. So that's why you're going to use this calculator. But yes, then it should be a pretty accurate, and you can do
Okay.
all your filing online, and they'll screen your spouse if you list him, for potential benefits, and then they'll just check in on what his pension situation is, what his earnings are, things like
Okay.
that.
Did you put that in the chat somewhere?
Yeah,
so
I can do
just,
this one now too.
Yeah, just so I can copy it. All
Mhm.
right, great. Thanks. That answers my question.
Yeah.
Thank you.
Great question. Thanks, Jane. All right. Okay, so yep, Megan and Alyssa, we should have the WEP and the GPO, government pension offset PDFs in there as well. All right, one more, Megan, if you have a second.
Yep, absolutely.
Okay, if I'm understanding your comments, a person who was a full-time public school teacher for their entire career is not eligible for Social Security benefits. Well, go ahead, Megan.
Yeah, I mean, again, I had my 40 credits from jobs when I was very young, but assuming that you did not get 40 at any point, then you're not eligible for a Social Security benefit. You probably are paying Medicare taxes on it, so you could get the Medicare, but you have to have 40 to get your own Social Security. It's 39 benefit, you get something, it's got to be 40 to get anything from your own retirement.
Yep. There may be access to spousal benefits, but those are most likely be reduced to zero anyway.
Correct. But yeah, that's always something we'll check for, but it's a lot of times reduced to zero.
Yeah. Great questions. All right. Well, let us know if there's any last minute ones. As always, those of you that are clients of ours, feel free to reach out to your advisor here at Klaas, and we'll be happy to answer any questions we can ourselves. If not, redirect those to Megan or direct you to your local Social Security office to get those questions answered. But Megan, any final thoughts before we let everyone go?
Nope. Thanks for having me.
All right, great. Great job as always. Thanks for joining, everyone.
Yep.
Bye-bye.
Good night.